Hello friends, I am Vishal Jain. Welcome to GST in Shorts. Now, as the due date of filing GST 9 has been extended, we can focus on the new GST return forms. In this video, we are going to discuss about what do we mean by return, what are the present returns, the challenges being faced in the existing returns, and the new set of returns. What do we mean by returns? Returns are nothing but a means of communication between the department and the taxpayer, through which the taxpayer declares his tax liability and claims ITC on self-assessment basis, which later on becomes a basis for scrutiny by the department. On July 1st, 2017, when the GST was introduced as a good and simple tax, there were three basic returns which were supposed to be filed by the normal taxpayer. GST 1, which would contain the statement of outward supply made during the tax period. GST 2, that is a statement of inward supplies received during the tax period, and GST 3, that is a summary of outward and inward supplies during the tax period, which was supposed to be auto-populated from GST 1 and 2 filed earlier. The system was designed so as to involve minimal human intervention, but ये सुंदर सपना टूट गया. The beautiful dream was shattered due to the hasty implementation of the law and the incompetent IT infrastructure of the GSTN. The government in no time brought the GST 3B as a scapegoat, which was meant to be there only for the first 2 months, but inactive till now. Just when that industry found themselves comfortable with the existing returns, GST 1 and GST 3B, the department is all set to replace these returns with the new set of returns, normal, Sahaj and Sugam, together with Annexure 1 and Annexure 2. The industry raised the concerns. Why this change is required? What is the concern? To which the government replied, they are missing the matching concept. They are missing the matching concept which was there in the originally drafted law. The law which was implemented on 1st July 2017 was designed such that the invoice level details would be uploaded by the supplier in his GST 1, which will be made available to the recipient in his GST 2A, whereby the recipient can either accept, reject or modify the details of his inward supplies and then can finally avail the ITC through GST 3. But due to the incompetency of the IT infrastructure, the government was never able to operationalize the GST 2 and GST 3 and has to rely upon the summary return GST 3B to check the claim of ITC. But since the invoice-wise matching cannot be made with GST 1 and 3B alone, the government was finding it difficult to identify the cases of tax evasion. To some extent, the government was able to identify the cases where the taxpayer was issuing invoices without making an actual supply, or the taxpayer was claiming ITC without making actual purchases. On the contrary, the instances were also identified where no invoice was issued for the taxable supplies. This has resulted in the tax evasion, which was against the basic principle of GST, which was to reduce the compliance burden with the overall increase in the tax compliance. This made the government to introduce a new set of return from October 19 on mandatory basis. The new returns will be replacing the existing GST 1 and GST 3B. The GST 1 will be replaced by Annexure 1 and the supplier will upload the invoice level details of outward supply. GST 2 and 2A will be replaced by Annexure 2, which will be auto-populated from the details filled in Annexure 1. GST 3, which was never operationalized, will be replaced by the return normal, Sahaj or Sugam. New returns. Under new return scheme, the taxpayer will be filing Annexure 1, Annexure 2 and either of normal, Sahaj or Sugam, depending upon the nature of transaction and the aggregate turnover in the preceding financial year. As the name suggests, Sahaj and Sugam are much simpler as compared to the normal return and are meant only for the small taxpayers. By small taxpayer, the government aims to target at the taxpayer having aggregate turnover up to Rs 5 crores in the preceding financial year. In case the person is having aggregate turnover exceeding 5 crores in the preceding financial year, then he has to mandatorily file normal return together with NHA 1 and NHA 2 on monthly basis, and tax also has to be paid on the monthly basis. But in case the taxpayer is having aggregate turnover in the preceding financial year up to rupees 5 crores, then he has the option to either file normal Sahaj or Sugam together with NHA 1 or NHA 2 on quarterly basis, although the tax has to be paid on the monthly basis. In case a person has aggregate turnover up to rupees 5 crore, then the applicability of returns Sahaj, normal or Sugam will depend upon the nature of transactions. In case a taxable person is having taxable supplies only to the unregistered person, that is B2C supplies, and is liable to pay tax on RCM basis on the domestic inward supplies, then he can file either of normal Sahaj or Sugam return. However, in case the taxpayer is indulged into making taxable supplies both to the registered person as well as the unregistered person, that is in making B2B as well as B2C supplies, together with the liability to pay tax under reversal basis on the domestic inward supplies, then he can file either normal return or the Sugam return. He cannot file Sahaj return. However, in case a person is engaged into making supplies to SEZ unit, EOU, or the export or import of goods or services, then he has to mandatory file normal return. Now the question strikes to my mind. If Mr. A is engaged in making B2C supplies, that is, he is engaged in making supplies only to the unregistered person, then he has the option to file either normal Sahaj or Sugam return. When Sugam and Sahaj return are much simpler than the normal return, then why would Mr. A opt for normal return? Think about it, and we will discuss again in the next video. Till then, take care.